Well, good morning, everyone. Thank you so much for being here. My clock says it's 10. We'll be respectful of your time and get the ball rolling. I can't tell you how much we appreciate you being here. It's always fun to have this group. I hope that you enjoy today's presentation as much as Shawn and I enjoyed putting things together for you. It's always fun each quarter that we put things out there and try to hit those things that are important to you. With a Sesame Street theme to start our day, our presentation today is brought to you by the letter T. T is in taxes and T is in tariffs. While generally you only hear from us once a quarter, we hope you enjoyed our presentation on the One Big Beautiful Bill Act we sent to you about 3 weeks ago. We hope to give you a general overview of the key issues impacting the U.S. and global economies. We do have some international attendees on the presentation today. We're always glad to have our friends from across the pond, so to speak, tuning in. We're focusing on the areas that will impact most of our attendees. So please note your questions in the chat box, and there's going to be ample opportunity in the latter part of the presentation to answer them. Several of you have submitted questions in advance. We always appreciate that because we get a chance to look up the answers. And we will address those when we begin the question portion of the presentation. And I'll make sure, as will Shawn, that we cover some of the things that are the questions, the burning things that are on your mind. So let's review a quarter when we actually got some answers to long pending uncertainty. Joining me today, of course, is my partner, Shawn McCabe. Together, he and I will strive to help you make some sense out of the economy and out of the market. I'll start with the market update. When we had our Q1 economic presentation just 3 short months ago, the market was beginning to recover from the 20+% decline from the peak just 2 short months earlier. We had just begun Trump 2.0, which had brought us tariff mania. Congress was debating the One Big Beautiful Bill Act to establish the tax rules for the near future and, as described in some cases, permanently. The U.S. economy was continuing to slow. Inflation had declined but was holding steady. The Feds were pausing possible rate cuts. The economy was doing well, but the consumer thought it was stinking. The Fed would continue to monitor their incoming data. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed rate adjustments would continue and result in a soft landing. Americans continued to spend money on fun with family and friends, travel and entertainment, even if they were having to spend a lot more than they did just a few short months ago. Shawn and I were begging clients, please turn off the TV. Please ignore the noise concerning doom and gloom scenarios, the economy, the markets, the components of the One Big Beautiful Bill. The mantra of hold steadfast and stay the course was repeated on a daily basis. As with every crisis that came before it, great companies adapted, improvised, and ultimately overcame. Since those dark days, the S&P is up about 1,000 points, almost 20% to where it is today. Once again, disciplined, long-term investors, not traders, prevailed. They're still batting 1,000. It was not different this time. This was where we were. Well, not much has changed. While Shawn and I will go into the details, the market has shown tremendous resilience over the last few weeks. In the last few days, even last week, the market's hit more highs than a band at a Willie Nelson concert. Unemployment remains steady, and we finally know what the tax rules are. Shawn, so much for the market. What about the economy?
Marshall, you got me chuckling a little bit about that Willie Nelson concert. That's interesting. Can't say that I've ever been. To that point, economic update, Marshall, you always make the point that when the market hits a new high, it's one of the most certain times, right? It's 100% of the time the market has recovered in our past history. So you say that a lot, and you said in the last slide we're batting 1,000, and that it just rang with me. It kind of set me back a little bit. That when we get in those down times, we tend to forget that, and it isn't different anyway. So good points, Marshall. So I really am going to come right out and say it. Some of you may not agree, but right now, as of right now, Jerome Powell is my hero. The pressure that man is under is unfathomable. As he has maintained a steady and often unseen hand at the Fed. From our small corner of the universe, I think he's doing a fantastic job. And with the current data we're about to briefly show, I see no reason to reduce rates. The only question is, will those numbers hold up until September Fed meeting? Labor markets, in my opinion, will be at the forefront of conversation between now and then. So stay tuned. You guys are going to hear all the mumbo jumbo on the media, and that's really what it's going to be about, is the labor markets. A lot of big numbers coming out in the next couple of quarters. Next couple of months. So the Fed's mandate, as we all should know by this time, because Marshall and I talk about it just about every presentation, is maximum unemployment and price stability with an inflation goal of about 2%. Considering GDP in relation to the current unemployment inflation, there's a lot of support for lowered interest rates. There's not a lot of support for lowered interest rates. And if you do watch any of the news channels, Jerome Powell is getting a lot of pressure from the administration. And I'd like to say that as of right now, the Fed is being data dependent and maintaining their independence. And that's a good thing. Chairman Powell explained yesterday that the Fed's current policy is moderately restrictive, but he also recognizes that current policy has not impeded growth as measured by GDP. Their wait and see posture, he's maintaining, I think, gives some good runway to, just in case tariffs do impact inflation in a more systemic way. All that to say, Chairman Powell meant to say, if it ain't broke, don't fix it. Problem is, the 5 actual data points on our highlights list here, the slide you're looking at, don't get near as much attention as the one that trumps them all: geopolitical and political issues. And Marshall, see what I did there?
Right. Nice play.
Yeah. So let's do some fast data review. I don't want to bore everybody with a bunch of data. We did that last quarter. But for comparison on GDP, we want to look back a year or two, kind of see how it played out, and then the most recent quarters. But as you can see from the chart, in 23, we had 2.5% growth in GDP. 2024, we had 2.8. In Q1, Marshall and I reported that it was a 0.5% decline in GDP. As more data pours in after the initial release, that was revised down to only being 0.1% down GDP. So still a down quarter. And then a nice little surprise upside at 3% GDP in Q2 25. Again, that historical context is important. Just if we're throwing data at you without something to compare it to, it doesn't make any sense. So where we fall in the historical average from 1947 to 2024, we're below average GDP of about 3.21, but right there in that sweet spot. Jumping to, let's see, where am I here? Inflation. We want to talk about the CPI, Consumer Price Index. In 2024, it was 2.9%. Q1 of this year was 2.4. Q2 was 2.7. So a little bit of a upside in inflation, like 0.3%, but nothing at all to write home about. So moving on to unemployment. If trend is your friend, so far I like the trend of unemployment. In December of 24, it was 4.3%. March of this year was 4.2. June was 4.1. And the historical average is 5.68. If you listened in to Jerome Powell yesterday, Chairman Powell yesterday, the Fed believes they have met their max unemployment mandate. So now they're just focusing on keeping inflation in check. So Marshall and I really like to look at the economic cycle just from a visual perspective. And this is kind of giving us an indication of where the U.S. is in the grand scheme of things. So if you've been tuning into our updates over the last few quarters, you may have noticed the U.S. has shifted into the late stage of the economic cycle, which would essentially reflect, and if the data was accurate, right, moderating growth, tightening credit, earnings pressure, downward earnings pressure, that is, increased inventory levels, and slowing sales. We're not seeing that, and I wouldn't be surprised to see the U.S. shift back maybe into the more mid or even earlier phases of growth, but between now and the end of the year. So all that to say, there's lots of good things right now that prop it all up. But keep this in mind. This slide is really just an illustration of where we are in comparison to the other economies, where we are in our own economic cycle. It does not move linear. It can stay in one spot for a long time. It can also jump phases. And really, again, it's just to give us an idea of, hey, visually, where are we? Where are we in the economic cycle? And again, I believe there's a lot of support that we'll see some continued growth, and we'll start itching away from that dreaded recession that everyone keeps talking about. So as far as sector rotation is concerned, not much has changed. As a matter of fact, where the green pluses are on this slide are in the exact same spot as they were last quarter. I'd like to point out that real estate, consumer staples, energy, and utilities tend to do better during a late cycle of economic growth. And as we were reviewing this, utilities is the only one of those that has been one of the top performers in as far as sectors is concerned year to date. Energy and real estate are a tad bit softer, obviously trailing technology and financials and some other sectors. So kind of points back to the previous slide of I don't think we're in that late stage of the economic cycle. I do think the tendency from last quarter to this quarter was a little more negative, but now we're seeing the data come out. We're seeing what's actually happening in the market and in the economy, and it's a lot more positive than everyone thought it was going to be. All that to say, I think investors don't seem to be as defensive as we'd expect if we were truly in the later phase of economic growth, preparing for recession, right? We're not there. All in all, everything seems to be kosher. So the current Fed funds rate is 4.33% and has been since December of 24. As illustrated by the black line on the chart on the left, it's a little hard to see. I'm cramming two slides on here. I think you'll get the concept of what I'm talking about here. The purple dots indicate the market's rate expectations for October and January, back in March, right? There's really two dots underneath that purple line. There's gray dots also, which means the sentiment hasn't really changed from the market between March and June. But what I really want to point out here is the Fed's expectation of rates is not as low as what the market's expecting. And you know, the point here is the market is expecting lower rates in the Fed, and yesterday's wait and see posture given by Fed Chairman Powell gave the markets a little nudge to the downside right before the close, if you were paying attention. To kind of help close this point out, and again, a lot of this is speculation. I mean, the data is strong, things are going well. And when that's the case, all people do is sit around and look at the data and kind of come up with a narrative, right? So the chart on the right shows the Fed sentiment on rates as indicated by those little blue dots. And those blue dots represent the Fed Open Market Committee participants' individual opinions, if you will, of where they think rates should be. And just as a general sense of things, you can kind of see how those group of dots, the average of those dots tends to shift down in 26 and 27. And the overall, you know, sentiment lands around 4% for 2025. We're at 4.33. So I just don't foresee a change in rates. I don't foresee a lowering in rates. And again, unless the economic data moves in a direction that you know, the chairman and the open market committee decide, hey, we probably need to get ahead of this. Will that happen? Who knows? The Fed has one more shot at it in September, but unless some of the aforementioned indicators do change, I doubt it. All right. Before I turn it back over to Marshall, I'd like to go on the record to state I'm not the only one who thinks Chairman Powell is doing well. According to this Bank of America survey, which we have shown before, it gives the sentiment of the participants of that survey on whether or not we're going to have a no landing at all, which is indicated by the gray bar, a soft landing by the yellow portion of the bar, and then orange indicates the hard landing. And as you can see, the far bar on the right, only about 10% of respondents are expecting a hard landing, right? So the street has spoken. They don't expect a hard landing as well. Most are expecting a softer or even no landing at all. I say that's a sentiment directly impacted by how the Fed navigates their dual mandate of max unemployment and price stability. They're doing a good job. And no one really compliments the government that much, but I'm kind of happy with what they're doing right now. So data is fun and all, but we all know what really drives volatility: headlines. And right now, geopolitical and political issues are leading the narratives. So Marshall, I'll hand it back to you. We can get a little closer to that word of the day or letter of the day, Sesame Street style, but I know you got some things ahead of that. So over to you.
Thanks, Shawn. I'll slip in a third T, and that's going to be tensions. peace is always a fleeting thing. And so let's look at some of the geopolitical tensions. And again, not much has changed in the last quarter. You still got Russia and North Korea versus Ukraine. This war seems to wage on, causing all kinds of humanitarian issues and creating more risk to investors with their capital flow in and out of the region and the products and items that they produce in that area. Now, world leaders are optimistic the conflict is contained, but there's just always risk of escalation and increased tension between Russia, NATO, and the West. I'm not sure how secure the information is or how informative the information is coming out. But as noted, the Ukraine and U.S. relations have been strained, and was, of course, with the new administration. However, on the other side of that, by my calculation, President Putin is flirting with a Trump-imposed deadline that's about a week from now. So we should see some activity in this area, hopefully to the positive side within the next 7 days. Okay, who saw the Iran bombing coming? The Hamas-Israeli conflict continues, causing instability, a lot of economic uncertainty in the region, and the same risk of escalation and hopes for peaceful resolutions. At the moment, there's some semblance of a ceasefire and ongoing negotiations as to what happens to Gaza in the long run. I don't have the answers. I'm not sure anybody has the answers on that. The U.S. and China are in full economic war. We heard some positive leanings this morning. We're hoping that we'll see some positive outcome and cooler heads will prevail in that narrative of my tariff is bigger than your tariff coming up. I'm not sure who wins in that battle. I understand the logic from both sides. We'll see what happens in the coming weeks. But the U.S.-China relations need to get squared away, and we need to reduce that tension. So lots of tense areas globally. I suspect this will continue through the remainder of the year and probably well into 2026. Just Marshall's call. On the U.S. side, the U.S. debt continues to run rampant and unchecked. Every vote that takes place, it seems, in Congress is just along the party lines. So the last time I checked, other than having a printing press to print more money, the government doesn't manufacture or sell anything. The government earns money via taxation. It may come in income taxes, fees, more debt, and yes, tariffs. But it comes directly or indirectly from us, the taxpayer and the consumer. Nothing's changed. It's not going to change. This is how it works. So offering to not tax certain sources of income or give a tax credit for certain activities, if you keep spending, it just means the money must come from somewhere else. Kind of kick the can or pass the ball. So at least as a result in the last quarter, we do have the One Big Beautiful Bill Act. This is a reality. And Shawn, tell us what we need to know.
All right, Marshall, I can do that. And Marshall, you had mentioned a few slides ago, I think maybe on an opening slide, that we did a presentation on the One Big Beautiful Bill Act a few weeks ago. So if you're tuning in today and you haven't had a chance to see that yet, we made it easy for you. Pull out your cell phone, scan that QR code. That'll take you directly to our YouTube page, where you can subscribe and just kind of see all of our previous economic updates. But we do have the One Big Beautiful Bill, our review, posted to that. If you don't want to scan that, you can just go to YouTube and in the search bar type in McCabe Gunn and we'll pop up there for you. And if you do subscribe, you'll be notified when we do our next upload. So if you're not able to make it here, you get that notification to your YouTube account, click it, and it drives you right to the video. So, all right. I would have promised my next paycheck that the headlines and volatility for the remainder of this year, Marshall, would have been about legislative uncertainty. The great news is we have our tax package, and the market can move on to worrying about tariffs and Chairman Powell, what he's doing. For today, though, I want to touch on a handful of provisions in the bill that impact many of you, many of us for that matter, and have caused some confusion out there on the World Wide Web of things. And most of that's usually around when they kick in and kind of how these things are going to go. So first up, while no tax on Social Security was a campaign promise, the legislative process modified it to be an enhanced deduction for seniors. But it still is a win for seniors, right? Starting in 2025, seniors 65 or older with less than 75K AGI single and 150K AGI married will receive an additional $6,000 deduction, and that is per senior. So two seniors on there, obviously married, filing joint, will get a $12,000 deduction in addition to the existing deductions. Again, this starts for 25, but the provision expires in 2028. All right. Next is the increase in the state and local tax, otherwise known as SALT. You've heard that kicked around, and that's probably, I think that was the main deal that slowed the bill down and getting passed, but finally did. But that SALT cap moved to $40,000 for folks who file with income less than 500K. This also starts in 2025, but good news is it increases by 1% per year through 2029. And then it reverts back to 10K in 2030. So again, a little confusing on some of these rules, but in general, that one's a short-term benefit for all of us. But if you do have over $500,000 of income, don't fret, you still get the $10,000 SALT deduction. For those on the border of itemizing, this could really be a good opportunity for you, especially when adding in the new auto interest deduction for US made cars, and regular charitable contributions above the new 1.5%, or excuse me, new 0.5% contribution-based floor that'll be imposed next year as well. I'm going to talk about those in a second. I know we just fast-fired those on you, but so and yes, there is an itemized charitable contribution starting in 2026, and with that must exceed 0.5% of what is soon to be prescribed as the contribution base. All right. So for the auto loan interest deduction, if you buy a new automobile in 2025 through 2028, and it is a U.S. assembled passenger auto, you can deduct up to $10,000 of the interest you're paying on that vehicle. Pretty cool benefit there. And you stack that with potential SALT and then also any charitable contributions you make, it may bring itemizers back into the fold a little bit more than in the past. No tax on tips and overtime was passed as promised, but with limits, and both are temporary. Again, both start in 2025 and end in 2028. For tips, up to $25,000 per year per person can be earned tax-free, but with a phase-out beginning of 150K and 300K of income. There are no phase-outs for the overtime portion, but the overtime portion is limited to $12,500. And I know, again, I'm fast firing these. If you do have questions, we'll have some time at the end to kind of dig into these a little bit. The next one is one of my favorites, and it is for non-itemizers to get the charitable deduction. You guys remember maybe back in COVID, I think there was a $600 deduction. Well, that's back and it's permanent. And that will allow folks to get up to $1,000 deduction per filer. So if you're married filing joint, that's 2K. But that one starts in 2026. And again, it's permanent, so that's great news. So we know that a lot of filers will be filing standard deductions because they just don't meet the itemized. So you still are getting the benefit of giving the charity. All right. And lastly, some of my attorney friends, this is huge news, but they had mixed emotions on this one. Some were very worried about a huge slug of work to come in if the Tax Cuts and Jobs Act provisions expired. And that is because of the estate and gift tax exemption amounts. We're going to revert back to pre-2017 levels. Great, exciting news. Those estate tax exemption and gift tax exemption amounts were increased, or will be increased next year, to 15 million single and 30 million married, and that's again in 2026. So those, what everyone was afraid of on the estate planning side, those provisions expiring out of the Tax Cuts and Jobs Act did not happen. It's been permanently extended. And an index for inflation. So there are many more. Those are my top 5 favorite ones, if you will. I guess there's 6 on this slide. But there are many other provisions out there. If you really want to see those, please go back and watch our video. But I want to touch on the businesses real quick for my business owners on here. 2 really exciting ones is the Section 199A, which is the qualified business income deduction, which pass through profit from pass-through entities to kind of keep up with the corporate side of things. Is there and made permanent. That was set to expire. And then bonus depreciation is back, baby. So those of you who took advantage of buying equipment and were able to take the bonus depreciation above the Section 179, it's pretty exciting that we're able to do that again. So a lot of tax planning opportunities are now available again for our business owners. All right. So the caveat before we get you back to our regularly scheduled program, keep in mind the law is in effect for these dates as we prescribed here, but agencies have not had a chance to iron out some of the formal details. So there still may be, hey, we don't quite know how that's going to be processed or worked yet, but stay tuned. This wasn't a major overhaul to the system, so I'm pretty sure we'll have a lot of this figured out long before the end of the year, and of course, by the time it's time to file taxes. So stay tuned. We'll keep you updated as we learn more. Yeah, so that's it for me on that, Marshall. Let's get back to the regularly scheduled program. I believe interest rates is up next.
Thanks, Shawn. Yeah, they are. But before we go, I want to highlight something on your screen here.
Sure.
You may remember when we had the Trump Tax Act in 2019. So many of those provisions expired in 2025. The logic of that, of course, was that Trump would not be in office. I guess not 2019, 2017. That Trump would not be in office after 8 years. So the Democrats and the non-Trump friendly Republicans could come to a compromise of putting certain things in the tax law, but making them expire whenever his term is up. Well, if you look at this screen, his term expires January of 2029. Pretty much a lame duck, of course, in 2028. And you can see how many of these hot political provisions expire once again at the end of his term. Certain easy ones like the charitable deductions, that's permanent. The state and gift tax, that got permanent. But boy, a lot of those moving parts are all going to expire in 28 and 29. And so, Shawn, while you and I can know what the tax laws are to help our clients and kind of take a deep breath, we know there's another train coming down the tracks, and we're going to have to help clients through that as we get through 28 and 29, especially in the itemized deduction area.
Absolutely. And excited to be here and stay in tune for everybody so everyone can focus on what they do best. So good point, Marshall. Thank you.
No problem. That was the political side. Oh, interest rates. Oh boy, my housing people here. I'm sorry, this isn't more fun screen, but obviously we know a critical driver of U.S. borrowing costs are the 10-year treasuries. The 10-year yield has held steady since last quarter. Not too bad, but not good either. And the driver of that, of course, is economic uncertainty and no rate cuts from the Fed. Home prices and mortgage rates have also held steady for Q2 2025, but activity is nowhere what it was in recent years. And the culprits, of course, are the interest rates, but supply seems to be increasing slightly. So at least my realtor clients have something they can show clients, potential buyers, even if that buyer is a little cautious because they're not as enamored with the mortgage rates that are out there today. Typically on the mortgage rates, and if you do the quick math on the screen, you can see that mortgage rates are generally the T-bill plus 2.5%. So until the 10-year treasury starts to drop, mortgage rates aren't either. So, and I don't see the 10-year, Marshall's call, I don't see the 10-year treasury dropping until the Fed lowers interest rates again. So maybe we get a quarter of a point in September, and that could stimulate some home buying in the fourth quarter. Consumer confidence is flat at best. U.S. consumers say they're very uncomfortable about the economy. The impact of inflation and tariffs on purchasing power and the uncertainty of the future cost of items like cell phones, vehicles, and shoes have caused consumers to rethink purchasing. Despite lowered inflation, low unemployment, decent job openings, they still aren't confident because of that uncertainty. We'll see what happens. Leading economic indicators imply there's a continued decline. Well, this is kind of interesting because we have the LEI telling us there's a decline, but yet we had a 0.1 decline in the GDP in Q1 and a +3. Now, I'm going to go on the hook. Here's a Marshall prediction. Marshall prediction is that 3% GDP increase that we saw for Q2 gets revised somewhere closer to 2.6, 2.7. But still, I mean, that's awesome considering what people are thinking about the economy. So, to summarize, consumers are feeling the economy is worse than it actually is. So, I'll leave it at that. All right, my big T word, tariffs. Okay, here we go. Shawn and I couldn't make this presentation without the T word. So, to kind of clear it up, a little history, we're a net importer of goods and a net exporter of services. We import clothes, electronics, cars, industrial materials. We export things like software services, financial services, telecommunications. Add them together, we're still running a huge trade deficit. So, what really is a tariff? Tariff's a consumption tax. So, if it's a consumption tax, it gets paid to the consumer. The burning question is, what is the ultimate market impact, is what we're looking at today from our quarterly update. And so I have to reflect on what's happened so far. So the tariff, the actual market impact, when Trump started making announcements, and you can't help but look at this charge and go to Liberation Day on April 2nd, when all of a sudden the companies that Goldman Sachs put that are very tariff sensitive stocks fell 11% in a day. The S&P fell 5% in a day. I mean, this is crazy when you look at the volatility of this and what went on in early April. And now we get down to July 13th, and he makes the announcements about the economic union, came out and says it's going to be 30%. And the market goes, oh, okay, whatever, and actually went up that day. This is crazy. So I personally think that the market has become bored with tariff mania, or investors are learning don't pay much attention to the initial rhetoric uh, because reality can be much different. We will have to wait and see. The market's always overreacted on good news and bad news. The one thing for certain, investors have become a little tested over the last 5 short years. They've been through the COVID world coming to an end. They've been through the doubling of oil prices. They've been through rampant inflation. Are they becoming a little battle tested? Well, I think they're becoming a little headline weary. Remember when you listened to the news to Walter Cronkite for 30 minutes a day and we believed every word? And now we get news 24/7, 365, and you're not sure whether to believe it or not. Sorry, I'll get off my soapbox. Investing in uncertain times. In the words of Bob Dylan, the times they are changing, but at least we have a better idea of what the rules are. The bull market continues. One of our registrants asked the questions, are we due for a correction? It seems like I get that every quarter. Keep in mind, corrections are a decline of 10% or more, but less than 20%. Well, we got one earlier this year, and the odds are good we may have another one before the end of the year. That's just the normal part of the process. Bear markets are declines of 20% or more, and recessions are shown in gray. We had that brief recession from COVID back there in 2020. But for the most part, we haven't seen any recession. We thought maybe when we had the decline in GDP for a quarter, we might get it a second quarter, but wow, look at the flip flop just in 90 days. So the key to all that is real simple. Diversify. Don't get complacent with your portfolio. As always, I apologize for the busyness of this slide, but there are lots of options to invest your portfolios, and each has merit. However, this year's winner can be next year's loser. Notice how growth stocks were the darling the last 2 years. But year-to-date 2025, they're down in the mid-range, down at 6%. Generally, large cap stocks, the darker green, remain in the upper area. But look how REITs, the dark blue, went from the cellar in 2020 to the penthouse in 2021, and then back virtually to the cellar in 2022. The key is to keep a diversified portfolio that meets your risk tolerance and goals. Notice how an asset allocation portfolio, the white boxes, had generally had good returns virtually every year. But Shawn, as we all know, there's always a reason not to invest in the market. Why not just sit on the sideline, earn my 4% and watch the market?
Good question, Marshall. I'll try not to spend too much time rambling on this one, but I could spend a whole hour talking about that question or answering that question. But I'll approach this one a little different, straight to the point. 10.8% is why. That's the average annual total return of the S&P 500, which means dividends reinvested, from 1973 to 2024, 51 year period. This ends up being north of a 20,500% period return. Let that sink in for a second. So if you had 10K in 1973, you set it in the S&P 500, didn't touch it, reinvested the dividends in the same allocation as the S&P, you'd have over 2 million by the end of 2024. Put a zero on that. You had $100,000. You'd have over 20 million by 2024. You've heard us say this many times before. Timing the market doesn't work. You have to be right on both sides of the trades, and the chance of beating the market on both sides of the trades are slim to none, let alone beating the market consecutively over time via using the stock market. The chances of doing that are slim to none. And Marshall, as you talked about, having a properly diversified allocated portfolio that provides the return suitable enough to achieve your goals is really the key. Because I always talk to people, I'm like, all right, why don't I just put my money in the S&P 500 and let it go? I'm like, do it. That's perfect. But what's most likely going to happen is between 2000 and 2002, where you got pummeled for 3 years in a row, and you didn't have your investment purpose tied to your financial plan. There's a lot of emotion involved in that. You are most likely to sell, most likely. And you've literally just decimated your portfolio. In addition to that, why not just the S&P and let it ride? Is when you're in retirement and you're drawing income off your portfolio, you got to be a little more tactful. You do want to be a little more into things that pay dividends. You want to avoid some high-flying PEs, because when those things come down and come tumbling and you're over-allocated, like the S&P can be, and you're drawing income, you can put yourself in a position where you don't recover. So that's really the answer, Marshall, is you got to be diversified, you got to be properly allocated, and you've just got to let the market work its course, because it does. And we can say this legally, I think, right, Marshall? 100% of the time, the market has moved higher. We can say that right now.
That's looking in the rearview mirror. So yes, we can say that.
Yes, sir. And that I think that makes the point. I'll get off the soapbox. I think we're all about soapboxes today. But before I turn it back over to you, Marshall, and for Q&A, I'd like to do something a little different, if that's okay with you.
Fire away.
So we're going to do the first FPAC. So it's the Q3 FPAC. So if you haven't fallen asleep on us by now and you're still paying attention, us CPAs, and maybe my military background, Marshall was laughing at me yesterday about this. We love acronyms. And for FPAC, for all of us on this call today, it's the Financial Planning Action Quarterly. Sounds cool, huh? This will be in the new segment on our quarterly economic updates, where we share a financial planning tip you may not have thought of, or it's something interesting Marshall and I have come across during the quarter. And as the slide indicates, this quarter, I want to talk about healthcare surrogacy, designation of healthcare surrogate, otherwise known as healthcare power of attorney. All right, so the best place to start with this is, for starters, 50% of Americans have not created their own estate plan. Think about that. That number has probably been right around that for the last 20 years, if not longer. But I also want you to know that 100% of Floridians do have an estate plan, even if they don't have their own written one, known as Chapter 732 of the Florida statute. And I don't know about you, but who wants the courts dictating what happens in the event of incapacitation or death? I don't want the court system doing that. Many other states also have promulgated intestacy laws, meaning dying without an estate plan for folks who actually don't have their estate plan, right? Case in point, many of you may remember the Terry Schiavo case. Terry Schiavo case was a series of court and legislative actions that lasted over a 7-year period regarding the care of Terry, who, if you remember, was in an irreversible permanent vegetative state. That's a mouthful. In short, Terry and her husband were young and did not have a living will or the other estate planning documents that would have prevented that whole debacle. Her husband wanted to pull the plug for Terry's sake, but her parents sued to prolong her life. Again, this was Terry's husband. He technically had the legal right, but her parents stepped in and said, nope, we think the doctors are wrong. We want to prolong her life to give her a chance to come back. And that battle persisted over 7 years. Ultimately, though, Mr. Shivo was able to peacefully lay Terry to rest after 7 years. God rest her soul. And the point here is this landmark case is an incredible and undeniable example of the importance of taking care of that pesky task that you keep pushing off of getting your estate plan done. All right, that's there. Now, I want to encourage all of you to get an estate plan, of course, for you and your family. But I want to focus on a smaller, less thought about scenario. Your adult, unmarried children, and maybe even your married children, right? I want to share a quick story. I have a friend who received a knock on the door at 2 a.m. There was a deputy and an EMS there and asked if his daughter was home. Before he realized what was going on, he bolted upstairs. The deputy and EMS followed him, got to his daughter's room, and she was unresponsive. EMS and the deputy pushed him aside, grabbed the daughter, threw her in the ambulance, and rushed her to the hospital. My friend followed him to the hospital, walked into the ER, not the ER, the waiting room. They wheeled her back to the ER and sat in the waiting room for about 2 hours, completely beside himself, him and his wife. 2 hours goes by. He goes up to the front desk and says, hey, I would like to check on my daughter. Can you give me an update? The lady types in the name, responds to my friend and says, sir, we don't have anybody here by that name. I don't know about you, but I would be a very unhappy camper at that point in time. And what happened in that scenario was his daughter was Baker acted, right, by order of the doctor. And the hospital has no legal responsibility. As a matter of fact, under Florida law, from what I understand, I could be wrong, but they are required not to disclose information on somebody who's been Baker acted. Privacy rules, HIPAA rules for his daughter. So all that to say, he did not get to talk to his daughter for 2 weeks. Luckily, a nurse was nice enough to. Daughter requested, hey, can I text my family? And they were able to conversate. But all that to say is, if you have unmarried adult children, please get a healthcare power of attorney and a HIPAA release at a minimum. Part of that package usually includes a living will. And so help your adult children complete that while they're at it. No one's thinking about that at 26-year-old. I know Terry Shivo and her husband weren't. So I'll offer this out as a service. If you'd like help understanding this or want to learn more, or getting your estate plan done, please reach out. We do have resources available to do some of it for you at no cost. Some of it has to be referred out to attorney or attorney group, but either way, it's really important. Please get this done. If you have any questions, you know where to find us. So, Marshall, I know this was a heavy topic for our first FBAC, but why don't we kick it off to questions?
Got you covered. If you would, of course, please type your questions in the chat box. We've had a couple of questions typed in. Thanks for sending those. Shawn, I'm going to ask you to field one of these for me. So you handed the ball and then back at you.
Okay.
Should we abandon certain companies because they may be impacted by tariffs?
We abandon certain companies because they may be impacted by tariffs. No, my initial reaction is, don't speculate on where the market's going to go because of politics, if you will. And technically, tariffs is still a political issue. I saw I can't remember where I saw it. And if I can find it, I'll send it out to everybody. But an article on the impacts of tariffs are about 50% baked into the market already. And based on the economics we talked about earlier, GDP's up. A lot of stock market prices are up. So in general, no, don't sell any of your investments based on tariffs. Matter of fact, if you're buying in certain investments for long-term holds in your portfolio, as we can say today, historically speaking, markets always recover, and we've been up 100% of the time. I said that wrong, but I think you get my point. So no, don't abandon that. And I want to caveat too, and say this. On these presentations, we are not allowed to, or we are not going to talk about individual equities or give investment advice. This is really for educational purposes only. So with that caveat, Marshall, I hope I answered that question effectively.
Well, I think so. And actually, as we were addressing that, a follow up on the potential impact of tariffs on the overall market, sort of a follow up to my slide a couple of minutes ago. And here's the key. If you're looking at, I'm going to call them the S&P 500 companies. That's pretty non-specific. That's 500 out there. These companies generally have a history of facing new economic conditions and finding a way to work around it. The workaround in many cases is they pass the price onto the consumer, and the consumer gets comfortable with it or has no choice. I'll run back again to when suddenly we found ourselves with a doubling of the cost of petroleum products. And as we've learned, petroleum is in darn near everything we come across. Companies figured it out. Companies passed on the cost. Consumer bought it or didn't buy it. And that was pretty much how it went down. I think we're going to see the same thing with tariffs. It'll probably be the biggest challenge on small business. That can be tougher because they may not be as able to pass it on to their consumer or pass it through multiple supply chains. We'll see. So always build your investment portfolio around companies whose profits are tied to the consumer and not tied to politics. So regardless of what happens in the economy or in the White House or in Congress, as I always say, people will continue using the Charmin, eating, taking their drugs, and using that cell phone. So I don't see any additional comments in. So please remember to follow us on social media. You can scan the QR code and you'll be linked to a variety of resources that we have available, and we want to share those with you. If you know someone who would benefit from our webinar, we'll be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it's posted, we will send each of you a link, and so you can go out and listen again or review a part that we presented. But as always, feel free to share it with your family and friends. Shawn, I don't see any final questions from our audience, so we either totally baffled them or we must have done a good job. We'll find out which way down the road. But our next scheduled event will be our Q3 economic update. We hope to see each and every one of you on Thursday, October 30th at 10 a.m. Thank you so much for joining us, and we look forward to meeting with you soon as we analyze the big, beautiful bill and look at the individual application for each of our clients. Thank you. Have a wonderful day.